Active funds versus passive funds. Which will perform better in the long run? One group of investors and analysts claim that active funds are better than passive funds, whereas the other group of investors and analysts claim that passive funds are better than active funds. Let us analyze and come to a very clear conclusion today. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions. Before we start analyzing active funds versus passive funds, first let us understand some basic criteria about mutual fund selection. How do we select mutual fund schemes? We have to understand. In that sense, first understanding your requirement is more important, then understanding the schemes, then the role of alpha. Then comes active versus passive funds analysis. We will do in-depth analysis and then we will take a final conclusion. When you are selecting your mutual fund schemes to invest, first thing you have to be clear about what do you want. Mutual fund has got different array of schemes. It has got equity funds, it has got fixed income schemes, it has got gold funds, it has got international funds. Even in equity fund category itself, there are plethora of funds. Large cap, mid cap, small cap, sectoral funds, thematic funds, tax saving funds, index funds, ETFs. In income funds, if you take, there are liquid funds, there are gilt funds, there are PSU and banking bond funds, overnight funds, fixed maturity plans, target maturity plans. There are plethora of schemes. So which one to choose? So when we straight away go to the schemes, you will be confused. So first thing is you have to be very specific and clear about what is your requirement, what you want. Are you looking to make money in the short term? Are you planning to invest for short term? Or you have got money for medium term? Or your goal is long term? So based on that, we have to choose. So in your financial roadmap, based on your financial plan, your financial planner will be able to tell you what kind of specific category of investment to choose. Evaluating your risk tolerance is more important. Either it is an active fund or a passive fund, both are equity funds. You can't invest for short term. You have to invest only for long term because there will be ups and downs, volatility. Do you have enough risk tolerance level? Do you have enough conviction in the stock market to stay the course? That your risk tolerance test will reveal. And as I told you, like, are you going to invest for short term or long term? These three things plays an important role. Your investment objective, your financial goals, your risk tolerance test. Then are you going to invest for short term or long term? Be clear with all these three details. That will give you clarity what kind of specific mutual fund schemes to pick and choose. After doing this exercise with your financial planner, as a next step, you have to understand different categories of mutual fund schemes, and in that particular category, you have to understand different schemes performance. When you are looking at, let's say you want to invest in large cap funds, you are looking at different large cap funds. Many funds may look like have delivered similar returns. If you look at the past performance, it would have looked like it is giving you similar returns. It is because you are looking at only point to point returns. Have they performed? Have they delivered better returns compared to their index? How are they ranked within their category? How are they performing better than their peers? How they have performed during their worst quarters? How they have performed during their best quarters? During a crisis-like situation, or Russia-Ukraine war, or pandemic, or an uncertain government, or election results. During this kind of event risk time frame, how the fund is handled. Understand this. If you look at many of our scheme review videos, we have reviewed many mutual fund schemes, not IPOs, not NFOs, the regular ongoing mutual fund schemes. There we have analyzed the return, and also we have analyzed the risk. right? With beta, standard deviation, alpha, Sortino ratio, Sharpe ratio, bad volatility, and capture ratio, right? Similar to that, you have to analyze mutual fund schemes from different perspective. You have to analyze from the return perspective. You also analyze the schemes from the risk perspective also. So there are many statistical tools to evaluate mutual fund schemes. One important tool to evaluate mutual fund scheme performance is alpha. What kind of alpha the particular mutual fund scheme is generating? Because alpha is the benchmark, alpha is the ability of the fund manager to outbeat the respective index. Why do we invest in mutual funds? Because we are not very sure how to manage it. Fund manager is an expert. He will be able to manage our funds better and deliver better return than the average, better return than the market. That way, if a fund manager is capable of delivering better return than index, that will be reflecting in the alpha. So alpha is a statistical tool that captures what kind of additional return he is delivering than the index. If he is a good fund manager, then the alpha will be positive. If he is a poor fund manager, then the alpha will be negative. If it is an index fund or a passive fund, alpha will be zero almost. Right. Now you know what important role alpha plays. Right. Now is the time we can actually dive deep into what is active fund and what is a passive. Active funds are funds where the fund manager will analyze the portfolio, analyze the stocks in the benchmark index and also stocks outside the benchmark index and pick and choose the best stocks. They will not randomly invest. They will not invest in all the stocks. They will pick and choose the best stocks. So when a fund manager analyzes stocks, he will have his own parameters, his valuation parameters, capital efficiency parameters, what kind of value proposition or competitive edge they have got, what kind of sustainability they have got, is this company easy to disrupt, what is the sectoral outlook, what kind of economic climate they have for this, what kind of governance they have, what kind of management quality they have, what kind of vision they have got. All those things they will check, right? When they check, if the result is positive, they will categorize that as one of the well-creating companies. If the outcome is negative, then they will categorize that company as a well-destroying company. They will avoid such negative outcome companies. Where the outcome is very positive and the outlook is very bright, then they will pick and choose those companies and give more weightage to those companies to invest. Now, as they are not investing in the entire index and they are picking and choosing the best lot from the index and investing, and based on the outlook, they are giving their own weightage for the selected stocks and investing. As they are doing it this way, there's a high probability they will be able to outbeat the benchmark index. Because they are not simply replicating the index, they are choosing the best stocks from the index. Because of that, they will be able to outbeat the index. And another important aspect of actively managed fund is they will be dynamically moving between sectors, dynamically moving between assets. See, if the outlook for IT sector is good, they can have higher exposure to IT. Tomorrow, after 1 year, the outlook for FMCG becomes brighter, they can move from IT to FMCG. If large cap is good and mid cap outlook is very dull, they'll have higher exposure to large cap. If the outlook changes very positive to mid cap, they can come out of large cap and invest in mid cap more. Similarly, they can invest in momentum stocks and defensive stocks based on the outlook. They can dynamically manage in actively managed funds. Fund manager has got 100% freedom. Because the fund manager has to do an in-depth research, it involves huge cost. So the expense ratio will be higher in the actively managed funds. Success or the failure of the active funds depends upon the stock selection and asset allocation rotation by the fund manager. If he picks and chooses the best of the best stocks, then it will go up higher when the market goes up. It will go down lesser when the market falls. So the ability of the fund manager is judged how far he is additionally delivering return when the market goes up, how far he is reducing the downside when the fund manager when the market falls. So this additional returns during the up market and like lesser loss during the market downfall is considered as additional alpha generated. We have looked at what is an active fund and what is its pros and cons. Now is the time to look at what is a passive fund. Passive fund is simply cut, copy, paste of index. The fund manager has very minimum role. He has to simply look at the index, what are all the stocks in the index, what kind of weightage is given to those stocks. He has to buy the same set of stocks in the same weightage. He need not apply his brain. Simply cut, copy, paste. That's all. He has to replicate the index. If Nifty has got 50 stocks and if it is an index fund based on Nifty 50, he has to simply buy those 50 stocks only in the Nifty and he has to buy in the same weightage. That's all. The fund manager will not look at the balance sheet, profitability, sustainability, easy to disrupt or not, management quality. Nothing is researched. No research is done. We invest in mutual funds relying on the fund manager because fund manager will do in-depth research. I don't have research capability. That is why I go to mutual fund. But whereas passive fund by design, they don't do any research. They simply cut, copy, paste the index. Advantage of passive fund is because there is no research involved, there is no in-depth fund, fund analysis. The fund management expenses will be very low. So the expense ratio is low, and you can be assured your index fund or passive fund will give similar returns of the respective index or market. Right? There are many indices which are well diversified. If you take Nifty 50 or Nifty 100 or Nifty 150 mid cap index, all those things are well diversified across multiple sectors. Though it is a passive fund, or enough diversification is possible in most of the cases. What are all the negatives of a passive fund? As you know, the fund manager is forced to invest in all the securities in the index, regardless of those stocks are worthy enough to invest or not worthy. There may be few stocks where the fund manager, he himself will not have enough conviction. He will think this company will deliver very poor return only. Regardless of that, he is forced to invest in index fund because this particular stock is part of index. His role is not to judge the performance, simply mimic and replicate the stocks in the index. And the fund manager does not have an option to let go of his investment in certain funds. Right? Say he has got 2-3 stocks which are not doing well, he can't let go. If there is a good stock which will perform better, he can't increase the exposure also. So the fund manager is not doing any analysis, any research. In a very simple sense, he is not at all taking any calculated risk. He is simply replicating the index. So he is blindly taking the risk. This is one of the major disadvantages of passive funds. Now you have looked at what is passive fund and what are the pros and cons. Now do we have to choose an active fund or a passive? Let us do a real analysis and see what kind of return this can give us actually. End of the day, everything boils down to what kind of return it is giving. Let us find out whether passive funds are giving more money to investor or active funds are accumulating more money for investors. Let us do a real life example and see. Active funds or passive funds are predominantly for long term because both are equities. In the short run, they can give negative returns. What is long term or long run? It is 7 years plus. So I have taken last 7-year period, whether the passive funds have given better return or active funds have given return. I'm taking an example of 1 lakh invested 7 years back and what is the present value. I'll take large cap, I'll take mid cap, I'll take flexi cap, I'll also take small cap. In each and every category, whether the active funds are able to outbeat the benchmark index. Finally, we will see the performance of passive funds also. In the large cap category, if you look at it, I have handpicked a few good large cap funds. Nifty 100 TRI has delivered 12.14% return in the last 7 years. 1 lakh invested has become 2,23,000. Whereas the best of the best large cap, active large cap fund, very asset large cap has delivered 14.12. The next best, Canara Blue Chip, has delivered 13.91. So 1 lakh invested has become 2,52 in Mire, and 1 lakh invested has become 2,48 in Canada. So that way, there are definitely good amount of scope even in large cap funds to outbeat their respective benchmark index. It is very clear from this data analysis. Now let us take mid-cap funds and analyze. A Nifty mid-cap 150 total return index. If someone could have invested 1 lakh 7 years back, the present value is 2,69,000. The annualized return is 15.21% return. Whereas the best of the best mid-cap funds have delivered 16.94, 16.74, 15.51. There are a handful of mid-cap funds which has outperformed the Nifty mid-cap 150 TRA, right? So, but there are also few large caps and mid-caps which has, like underperformed the benchmark index. I'm not denying that fact. Flexi cap funds, we have handpicked a few schemes, and most of these schemes have outperformed the Nifty 500 total return index. Nifty 500 has delivered 12.50% return. 1 lakh invested has become 2.28 lakhs. Whereas the topmost performing flexi cap fund for the last 7 years is Quant Flexi Cap. It has delivered 1 lakh invested has become 3.39. The annualized return is 9.06. Whereas in Parak Parik, the net return is 16.80. 1 lakh invested has become 2.96 lakhs. So that way, there are definitely good chances in flexi cap to outperform the index. Next is small cap funds. Small cap funds again, I have taken a handpicked a few schemes. Most of the schemes have outperformed the benchmark index. Nifty small cap 250 in the last 7 years has delivered 12.40%. 1 lakh invested has become 2.26 lakhs. And most of the small cap funds, say SBI small cap, 1 lakh invested has become 3.78 lakhs, 20% return annualized. Nippon small cap, 1 lakh invested has become 3.77 lakhs, again 20% annualized return. Kotak small cap, 19%, Axis small cap, 18.9%. So that way, there are many small cap funds which have outperformed the respective benchmark index. Now, I have listed the performance of large cap index funds, passive funds. Nifty 50 total return index has delivered 12.15% return. Most of the index funds, they have to simply cut and paste the respective benchmark index, but they themselves have underperformed the index because of the tracking error and the expense ratio, right? It is because when they track a fund, it is difficult for them to exactly mimic and replicate the index all the times, because mutual funds have to maintain some portion of the money as liquid money, because when there is a liquidity, they have to face the liquidity. And also when there are buy and sell transactions every day, it is difficult to exactly mimic the index on a daily basis. Also, one stock is getting replaced in the index. One stock is moving out of the index and a new stock is coming into the index. Then it will be tough for the fund manager to do it. In the index, it is a simple entry. Stock is does a simple entry change. It removes stock X and adds stock Y. But whereas for the fund manager, he has to sell 500 crores worth of X stock in his portfolio. He has to buy 500 crores worth of Y stock. He can't do it on a single day. He may do it in 2 to 3 weeks time. So for that 2 to 3 weeks time frame, the portfolio will not replicate the index. Also the portfolio, he will be buying at different prices than the index. So that way passive funds will have tracking errors, and because also they'll have expense ratio. Fund manager, though the fund manager doesn't do any active analysis, there are fund management expenses charged reasonably less. However, there are fund management expenses Again, these fund management expenses will reduce the overall return. Now, what are the key observations from the analysis period? We have taken the last 7-year return and we have seen few insights. What is the final observation? One important observation is active funds has got the potential to outperform the passive funds in the long term. That is what the data has clearly proven to us. In the short run or in one particular period of time, it may be like index funds are performing equally, performing better than active funds. But in our analysis, for a 7-year period, active funds have outperformed by and large the passively managed funds. Also, in the last decade, if we study, active funds have outperformed the index. And there is one more study that says a country like India will have more actively managed funds outperforming the passive funds. Whereas in the developed country like US, passive funds will be better because active fund managers will be finding it difficult to outbeat the index because it is a matured market, it is a developed market in the US. There it is difficult to outperform the index. Whereas in India, it is still is not a developed market or not a matured market. There is enough scope for the fund manager to outperform the respective benchmark index. So therefore, active funds are actually better than passive funds as far as the return potential is concerned. But there is one risk you have to understand. Selecting the right actively managed fund which can outperform the index. If you are choosing a wrong actively managed fund, which is actually not performing well, which is generating negative alpha, then in that case, that actively managed fund can deliver less than the index. Now there is a challenge here. So what should you do? It depends upon what kind of investor are you, right? There are some situations choosing active funds are better. There are some other situations choosing passive funds are better. First, let us look at it in which situation you have to choose active funds. Number one, you have the ability to select good actively managed funds. I know how to select. I have got research ability. Then go ahead and choose actively managed funds. Or you have a financial planner or an investment advisor or an intermediary who can select good actively managed equity funds. Then in that case also you can go for active funds. And you have relatively higher risk appetite. Means like you want to take more risk than the index in order to generate alpha. And active funds can generate alpha. So you are looking for additional return than the index. If these things are your requirement, means you have the ability to choose the best funds either yourself or through your planner. You also have additional risk appetite. Also, you want to generate additional alpha compared to the index. In these three cases, it is better to choose actively managed funds. When is it right to choose passive funds? Because I don't know how to select an actively managed fund. I am new to this active and passive concept. Also, I don't have a trustworthy financial planner or advisor or an intermediary who can select good actively managed funds. Also, I don't want to take much risk than the market. I'm comfortable if my portfolio generates returns which are similar to market, returns which are similar to index. Then in all these cases, it is worth to invest in passive funds. Maybe you can start with passive funds. Once your circle of competence expands, then you can think about investing in actively managed funds. So in a nutshell, what decides between actively managed funds and passively managed funds is your financial roadmap, your financial plan. Your financial plan actually tells you what is your investment objective, what kind of risk tolerance you have got, and also on top of it, selecting right actively managed fund is within your circle of competence, or do you have a financial planner or advisor who have enough competency to select a good actively managed fund. Based on these things, you have to select right actively managed fund. If it is not possible, then go for passively managed funds. Later on, scale up to actively managed funds. Hope you have got a detailed 360-degree idea about actively managed funds and passively managed funds. If you have any additional questions, feel free to book an appointment with our certified financial planners. They will be more than happy to clarify whatever the questions you have got on actively managed funds and passively managed funds or any other investment options or anything related to achieving your financial goals. I have given a link below this video in the description to book a free appointment with our certified financial planners. We regularly organize insightful investment webinars to educate investors with investment experts. You can, in fact, chat with our investment experts during the webinar. If you want to participate in those webinars for free and learn good long-term investment strategies and wealth creating techniques, please register in another link which I have given in the description and leave your name and email ID. I will book a seat for the next upcoming webinar and share the invite. Hope you have liked this video and I'll again meet you in yet another useful video. Thank you. Bye-bye.